Today we're exploring the fascinating world of inflation. What is it, and how does it affect us? Welcome to What Matters to You Today. Inflation is the rate at which the general level of prices for goods and services rises, eroding purchasing power. Essentially, it means that over time, your money buys less than it used to. Imagine you could buy a loaf of bread for $1 a few years ago, but now that same loaf costs $2. That's inflation at work. There are several causes of inflation. Demand pull inflation occurs when demand for goods and services exceeds supply. For example, during the holiday season, the demand for toys can skyrocket, causing prices to increase. Cost push inflation happens when the costs of production increase, leading to higher prices. This can be due to rising costs of raw materials or labor. Built-in inflation is linked to adaptive expectations, where workers demand higher wages to keep up with rising costs of living. This creates a cycle where higher wages lead to higher costs for goods and services. Inflation affects us in various ways. Reduced purchasing power means your money doesn't go as far. Think about how much more expensive groceries or gas might feel compared to a few years ago. Increased cost of living can make it harder to afford basic necessities, affecting your overall standard of living. It can also erode the value of savings, as money saved today may be worth less in the future. For instance, if you save $1,000 today, but inflation is at 3% per year, in 10 years, that $1,000 will have significantly less buying power. Inflation is measured using indices like the Consumer Price Index, CPI, which tracks the price changes of a basket of goods and services. This basket includes everyday items like food, clothing, and transportation. Another measure is the Producer Price Index, PPI, which measures the average change in selling prices received by domestic producers for their output. Understanding these indices helps us gauge how inflation is impacting the economy and our personal finances. Managing inflation involves various strategies. Central banks use monetary policy, adjusting interest rates to control inflation. For instance, raising interest rates can help reduce spending and borrowing, which can slow down inflation. Governments may implement fiscal policies to influence economic activity, such as adjusting tax rates or increasing public spending. Individuals can protect their finances by investing in assets that typically outpace inflation, like stocks or real estate. For example, historically, the stock market has provided returns that exceed the rate of inflation over the long term. Another way individuals can manage inflation is by diversifying their investments and considering inflation-protected securities, like Treasury. Inflation-protected securities. Tips. These are government bonds that are indexed to inflation and can help maintain the purchasing power of your investment over time. Additionally, maintaining a budget and monitoring your spending can help you adjust to rising costs and avoid financial strain. Thank you for watching. Understanding inflation helps us navigate our financial lives more effectively and make informed decisions about spending, saving, and investing. If you enjoyed this episode, don't forget to like, share, and subscribe. See you next time on What Matters to You Today.